welcome to this video where we'll do some volatility analysis around the upcoming earnings and break down some potential plays. So as you can see, earnings season is starting with banks basically launching the season early next week, and then some very interesting names that are reporting, such as TSM, ASML. So if you're a bit familiar with earning strategies or curious to learn more about how to profit from this volatility, stay tuned. All right, so as you know, earnings offer a lot of opportunities for option traders beyond just the gambling aspect of it, of buying just calls or puts and betting on a direction. These are what we call volatility strategies. And so we can play this volatility by either betting against or profiting from IV crush. And so in this video, we'll focus around the workflow of selecting and calibrating these volatility strategies. So make sure you're familiar with at least the basics of options, of the pricing, the Greeks, etc. Now, as you know, the main event on earnings is the IV crush. This is basically the reason why implied moves are higher than usual on earnings dates. And so the whole edge comes from basically benchmarking this implied move versus past moves and past behaviors in order to play the statistical edge of betting against this IV crush if we believe the implied move is undervalued or there's opportunity for the stock to move higher than that, or symmetrically basically profit from IV crush and sell options rather than buying them, in basically betting that the move will be underwhelming and contained within the this implied move. So as we're looking here in the upcoming calendar for next week, as we mentioned, a lot of interesting names. Let's go ahead and directly log into the platform and do some workflow and some analysis to basically see what the opportunities look like for this next week. So let's start by looking at the next week's basically calendar in this interactive format where we have a lot of information to sort by. We selected for the full week and only liquid options that are comfortably or easily tradable. And so let's take a look at the upcoming week and the different names we have, along with some high-level metrics that will help us basically start our research. As you can see, the average move, the standard deviation, the last move, etc. Let's do something very simple and basically see which are the stocks that had the highest moves in the past release. And so maybe that can be one path of researching. For example, also another path could be to sort by the average move or the standard deviation. Then deviation, these are metrics around the dispersion of the past moves. And so the higher that number, the sort of overall volatility of the stock is quite high. Now we notice that the first candidate is ASML with an implied last move of 11%. That's quite high, actually quite double the average move that we see here. And the current implied seems to be sort of catching up to this recent volatility with around 8.1%. And so let's actually go ahead and study a bit more of ASML, see how the moves were and what kind of plays we can do. Now, right away, we see in this, as we go to the moves analyzer, we see the past moves break down and notice directly a lot of shades of blue. This is a good sign, as basically blue lines correspond to earnings where the actual move was quite higher than the implied move. And you see that basically there is a trend in recent years, starting 2023, of basically ASML consistently beating or not having at least low moves on earnings. This is not necessarily the case as we scroll down in the previous years, going back to 2020 and before. So now let's scroll down and basically now benchmark, see how this recent volatility or this volatility is shaping up. We notice here the average move of 5.8 and the standard deviation of 2.9. This overall is around the period of basically since 2013, so the last 10-12 years. So this is the overall behavior, if we like, if we want to be the most statistically comprehensive. And as we scroll down, we can compare basically the actual moves and the implied move. We see that the current implied move is a bit higher. This is what we noted, that the market seems to be catching up with this recent volatility. And as we scroll down, we look at these numbers where these are very favorable numbers for long volatility. So again, betting that the move would be higher than the implied, simply because not only the frequency of beat is quite high, so 13 times out of 16, basically, where the actual beat the implied move, but especially what we like is these two stats where we can see that when the actual move beats the implied, it does so on average by around 3.6%, basically. While when it misses it by 1%. Now, this big difference, where basically it's a 3-to-1 ratio, is quite favorable for us for these long volatility plays, where we see that if it beats, we have a good chance of a big move with a high amplitude. And however, even when it misses, it doesn't miss by a lot. So this reduces our losses, basically, while the worst case scenario, as you would expect for earnings moves, would be that the stock does not move at all on earnings. For these long volatility plays, we see that it has not been the case, and is rarely the case usually for any stocks, especially not for ASML. Now, finally, the very interesting aspect that we noted earlier on is this recent volatility. So let's go ahead and filter basically these numbers to only the last 2 years. And here directly we see that the outlook is sort of changing, and notice this very high average move now of plus minus 10%, nearly double the one that was calculated over the 10 years period. This comforts our thesis, basically, that it is a recent mover, and perhaps the market is not necessarily catching up as it should be, especially if we look so now at this graph. Now, with these analysis in mind, let's go ahead and basically see how we can apply this insight and this analysis into actual option plays. So as you know, classic positions that we play for long volatility are straddles, strangles, or inverse condors, etc. So here we move to the simulator. This is basically an option pricing simulator that really models the famous IV crush that happens on earnings. As we said, this is what's responsible for these high implied moves. Here, randomly, basically by default, it loaded on an out-of-the-money call for ASML, and we just see for this example how the IV is projected is today, at 74%, and is projected to drop to 50% after release. Now, the good part is that we can translate those numbers into break-evens and P&L numbers that will be interesting for us to study. So let's go ahead and compose that classic straddle we discussed. So as you know, a call and a put at the money. Here, by clicking on classic strategies, I can directly access these pre-composed positions, and so start analyzing them directly. Now, basically, we're looking here at the 945 call and 945 put for the next week expiration, the closest one. And as we scroll down, so we notice the important number we need to keep in mind, this plus minus 8%. And so we see that this 8% is actually a bit undervalued if we compare it to that average move we looked at for the last 2 years, not the last 10 years. The last 10 years showed an average move of just plus minus 5%, because we were looking at the overall behavior. But if we focus on the recent years, we see that this recent volatility is basically not really priced in as it should, where the implied move is quite low. Now, the simulator allows us to basically see how the position that we compose, any position we compose, will behave. Now, we know we have these IV crush numbers, but we'd like to translate them into actual P&L figures, etc. And so this is what we see in this section right here. Now, notice how the very worst case scenario, actually the stock really not moving at all by Wednesday, which is the first trading day after release for ASML, or even for that case of really 0% that we noted as quite unlikely to happen, as stocks move a bit on earnings, especially stocks like ASML. Well, we are looking at a loss of a 63%. So this is the very, very worst case scenario. And again, no one is protected from an outlier or a black swan event. So you should keep in mind this number, and worst case scenario, be ready for it if you choose with these to go with these types of position. However, if we simulate, for example, let's say the average move of 10% that happened that we saw in the moves analyzer, so moving the slider here, and let's find the 10%, we see that we're looking at basically a profit of 23% 23%, which is quite favorable, not huge, but quite respectable, especially from this classic straddle position. And as we move the simulation up, for example, now we remember we saw that the average move was at 10% and the standard deviation around 3% for that last 2 years. So it gives us a benchmark that perhaps the maximum of the tail or the a good scenario would be on 13% move, plus or minus, of course. And so here, simulating the 13%, we see that we're looking at a reward of 64, basically. So this gives us an idea of the actual reward and risk as we looked at, and decide if this is something we are comfortable with. Now, keep in mind, this is only one type of position to play these long volatility strategies. For example, you might not be very comfortable with this big loss, even in a really worst case scenario of these 0% move. Now you can basically change your position into what we call an inverse butterfly. So as you know, this is basically selling wider strangles around basically our long straddle to reduce our cost. Also, as we will see, reduce our break even. So for example, let's select this inverse butterfly here. We are long the same straddle we looked at, 944 on the call and the put, but now we went ahead and we sold the 925 put and the 965 call. As we scroll down directly, we see that this last really worst case scenario move PNL, again, very unlikely, but really worst case would be a 14% loss compared to that 60%. And then on the other side, if we also simulate a high move of that 10%, see that our reward is quite low, only 6%. And as we move up to that very favorable scenario of 13 or 14% move, we're looking at a 7% reward. So this just gives you an idea of how you can play earnings different ways, basically by combining different positions, and not basically all plays have to be either multi-baggers or lose 100%. You can also go for plays like this. And notice also here, this sort of advantage that we reduced our break even to only plus or minus 6% overall, which again, keep in mind, is very undervalued, especially if we look at the 2 years value that we saw around 10%. So this is sort of a very likely position to be profitable, but again, the risk reward is just very conservative. We're not looking at the big 100 to 100% return. Those would be straddles, strangles. And so you can play around and basically allow different sizing on your portfolio. And remember, you can paper trade positions on our platform. So you can basically practice and refine your strategy. And so here, select the long volatility and then paper trade to find it in my home screen. To wrap it up, another way of, so we basically, we're looking at an analysis of ASML from our calendar and doing this custom sorting basically of the columns, etc. Another way is to use the volatility scanner. Basically, this is a tool that looks for these different positions, as you see, for long or short volatility, so straddles, strangles, inverse butterflies in the case of long volatility, and scans them through all upcoming earnings of the week. And so you can start selecting from here basically the positions that fit where the break even is quite lower compared to the past average, etc. We find the ASML plays we were looking at, but we see that there are multiple other potential candidates for long, but also for short volatility. And so you can basically start your research from here instead and go from here to the simulator and study more the positions and the past moves, etc. Voila, so this gives you an idea of basically the different ways you can play earnings. We didn't go into everything, obviously, so we just did the case of long volatility. Feel free to do the same for short volatility or selling options, etc. on now sort of overvalued names. This is something you can do by, again, filtering for 4 weeks, etc. and looking at the overvalued section. So this is just a workflow to show how, again, earnings are certainly fun to gamble on, whether, you know, ASML is going to move up or down after earnings. But more than that, these volatility strategies that, by the way, have been around for quite a long time, we just basically made the tools to make them accessible, really rely on what we, as we have seen, the statistical edge, really benchmarking the data. And the goal is not to put it all on one play or one trade, but really to again play the statistical aspect of it, and so repeat every week after week or with multiple names these stats of low average, low implied move versus the average, high amplitude of beat versus miss, those sort of numbers. So week after week, be guided by the numbers, and so play this volatility edge, really driven by data. Thank you for watching. Hope this was helpful. Let me know in the comments if you have any questions, and see you in the next video.